we go.
All right. I think we're live here. This is the Tax Review Commission. We're back online, virtual meeting. So meeting call to order at 2:01 p.m. Hawaii time. It's July 14th, 2026. Again, this is the Tax Review Commission, and this meeting was provided appropriate public notice under the Sunshine Law of the state of Hawaii. So I'll call the roll real fast. This time in order in which you all joined the meeting today. So the first one I saw was Judy Chalk.
I'm here alone.
Cool. And John Yasuda.
Present, alone in my office.
Excellent. And Stacy Katakura.
I am present and alone in my office.
Fantastic. And Jessica Enos next.
I'm present and alone in my office.
Cool. And then Mark Fukunaga.
Present and alone in my office.
All right. And I'm here and alone in my office. And Jeffrey Uyoka, excused. He emailed earlier saying he couldn't make today's meeting. So we have a quorum. That's 6 of us. Thanks for being here. So note before we start into the agenda, you might have noticed on the agenda there's no speaker on regressivity. I tried. I wasn't able to secure that. I have another option. So I'll try that unless there's some objection. Doesn't have to be next meeting. We'll see what, if there's stuff for next meeting, then we can put it off to the next meeting after that, if I'm able to get something sorted out for that. So sorry about that. Just didn't work out. So first real agenda item, communication to the commission and public comments. By bars, did we receive anything, or is there anybody in the wings?
We have not received any communication, and I do invite the attendees to use the chat function. We have Dr. John Knox as part of the attendees. He, had graciously offered to provide support and feedback about the TAT and tourism taxes topic, which he's an expert in. And as you know, he was a former TRC chair. So he's watching the meeting today. But anybody who wants to raise any point from the audience or the public, we invite you to use the webinar chat.
All right.
I'll give it a minute.
Yeah. Cool. All right, not hearing anything, and Vibar said it. We'll take public comment anytime. Specifically this time of our meetings, you can submit written comments as well. Information for that's on the website. All right. Discussion and vote of the minutes for the prior meeting. We do this every time. So let's consider those. The meeting minutes are online, and they're part of the meeting agenda materials and everything. There's also a recording on the YouTube link on the webpage. So are there any changes to the minutes right now, or requests for extra time to review the minutes? All right. I'm not hearing anything. I don't have any changes either. So if there's no other discussion, we can consider those minutes approved unless there's some objection. Looks good. All right, the minutes are approved. That's the minutes from the last meeting, the in-person meeting. All right, next agenda item, update from, I guess, me and Judy, one or the other or both, on contact with the Senate Ways and Means and House Finance Committee. So just, I guess I put this on here just so we could report back. Judy, do you want to start? Go for it.
Sure. So following the commission's recent discussions, I reached out to Senator De La Cruz's office to provide an update on the commission's work and to seek guidance regarding how the legislature would like to communicate with and receive updates from the Tax Review Commission during our review process. So Senator De La Cruz asked his WAM clerk, Scott Fuji, to respond on behalf of the committee. And Scott provided several suggestions that I believe would be valuable for the commission to consider. So the first one, he suggested we should have a very clear timeline He said the legislature would find it helpful if the commission develops a clear project timeline, including what commission intends to accomplish, major phases of the project, expected completion dates, and the major milestones. So Scott noted that after reviewing the commission's meeting minutes, he said it's a little bit difficult to identify an overall project timeline beyond the statutory reporting deadline. Any question on this point? And then the next point is define expected outcomes. So the legislature would also like to clearer understanding of the final work product. So the question would include what recommendations will the commission ultimately produce, and what decisions or policy recommendations are expected, and what analyses will be completed before the final report. So having these outcomes defined early will help the legislature better understand the commission's direction. Then the next one will be provide periodic updates, because I did ask them if they want to, how frequently they want to have the communication with us. So they said rather than waiting until the final report is completed, the legislature would appreciate periodic updates as milestones are reached. So these updates would include like a work completed, preliminary findings, challenges we encountered, emerging policy issues, and an area where legislative guidance may be beneficial. So this would allow the legislature to provide a feedback throughout the process instead of at the end. And another one point they also said, identify area where legislative input is needed. So Scott specifically mentioned that the legislature would appreciate knowing when the legislative input would be useful. So the commission could identify questions such as, are we evaluating the right issues, or are there policy areas the legislature would like us to prioritize? And are additional studies needed? So this creates an ongoing dialogue rather than just a one-way reporting process. And also, I mentioned some tax credits we studied last meeting, and one of the most important suggestions was the commission evaluate the tax credits not only based on the fiscal impact, but also on how they support Hawaii's long-term public policy objectives. Example provided is like increasing Hawaii's food production and achieving the state's net zero energy goals by 2045. So this is very specific actually in the communication with the legislature. This suggests that each tax credit review should consider economic effectiveness, fiscal impact, measurable outcomes, and alignment with statewide policy goals. So the suggested next steps for commission discussion, they said that they would like us to consider, so just give the commission work plan, including the timeline, major milestone, deliverables, and the responsible work groups. A reporting schedule, possibly like a quarterly or milestone updates. So they didn't really specifically say how often we should meet or communicate, but they did say some major milestones if we want to update them. We want to update with the WAM committee, House Finance Committee, and other interested stakeholders. For each credit, we should consider original legislative intent, economic benefit, fiscal cost, administrative complexity, utilization, return on investment, alignment with state priorities, and recommendations, like retain, modify, sunset, or expand. So I know that's a lot to consider. But determining whether the commission wished to establish a regular communication with the legislative staff during the review process, which I can continue to keep the dialogue with Scott and the senator's office and during the review process, so the feedback can be incorporated before the final report is issued. So the question is, I think I outlined that there are probably 5 we probably should consider is like the timeline, overall project timeline, the milestone as they mentioned, and also about standard framework for evaluating the tax credits. And what statewide policy goals should be incorporated into our analysis, and what additional information we need help from the legislature that can make our decision. So I appreciate it, Scott and the Senator De La Cruz's office taking the time and actually provide a thoughtful feedback. I think their suggestions present an opportunity for us to strengthen our communication with the legislature and to ensure our work product is both useful and actionable. So one item I think Scott didn't really mention, but it fits naturally through all his comments, was develop a prioritization matrix for tax credits. But not all credits needed the same level of review. I think the commission could rank credits based on the annual fiscal impact, number of taxpayers claiming the credit, economic significance, complexity, and whether there is sufficient data that can actually evaluate the effectiveness. So these are all I had since our last meeting. That's all the communication, and I emailed them and also followed up with the field costs, and this is the feedback I got from the senator office so far.
All right, thanks, Judy. Any reaction to that from the members? Hang on, Mark. I think you're muted still.
Yeah, I think this is a helpful dialogue. I think we want to be open about our discussions. I want also to be careful that we aren't asking for approval, on what we're doing, because I think we have a separate charge under the law to explore what we as a group think is right. So I think we've already discussed some of the topics, the pension issue today, the state competitiveness in terms of tax, in attracting investment and people, regressivity versus, the degree of regressivity, I guess. I think all of those are, fairly straightforward, and we can talk about timelines and what have you. The tax credit one, I don't know whether it is we have the resources to do if I'm hearing correctly, a case-by-case ranking of them, because I think the focus for us is more on the methodology as opposed to really tying it to substantive policy, which I think really gets into a serious research project potentially for every single tax credit, looking at the legislative history and the policy behind it. So that one, I think we have to kind of define exactly what we're doing so that we're all on the same page with WAM and House Finance. But anyway, those are just some initial thoughts.
All right, cool. Thanks, Mark. Any other reactions? Y'all probably know I got some reactions. I'm with Mark. I don't want to get into approval. We're meant to be, independent of them and everything. Our just knowing what happened last time, the drafts of our reports will be on the webpage, and we can draft an email and send that to Scott and maybe one of Rep Todd's finance chair's staff too, just so they don't have to go to the website and get it. Those drafts, I guess, could be a milestone. Getting the consultant's report, to the extent there is one, or if there is one. Can't wait for an update on that later, our next meeting or whenever. That's another milestone. But I don't want to get too heavy in like trying to make sure we're doing what they want us to do. I'm really prickly about that. Stacy, you're unmuted. If you want to share something.
Yeah, and I just was gonna kind of agree with both you and Mark. I mean, I think he did say that he went and looked at the minutes, but some of what he asked are already outlined, I think, in the minutes to the meetings. Like the timeline, I believe, is for our milestones, the timeline of when the report's gonna be due and all the way through the end of the year. I think that's publicly available, and if we want to summarize it for him, I guess that's fine. But I think we have the agenda item later on for the meeting to evaluate the framework or establish the framework for evaluating tax credits. So I think maybe we can consider that to help us. But I agree. I think we should taper that with what's reasonable and achievable during the rest of our term.
Yeah, thanks. Anybody else? Yeah, Jessica.
Yeah, I think the tax credit thing sounds like a big project. I mean, to go through every credit and I don't know, set a framework to evaluate, and then I'm assuming then we apply that evaluation criteria to every credit, and then I mean it's gonna take time to even get the info. I don't even know what info is available. So yeah, and I mean there were a bunch of credits in that SB 3125. Is that something they're asking us to include those two that have already passed, of what they want to do with it? Or is it?
I think we should identify which credits we can look at.
Yeah.
Well, I mean, we can definitely, we've talked about this before. We can definitely identify a handful and stuff. But to what Jessica's saying, like credit by credit, Mark said this too. Like years ago, when I was still at the department, like probably almost 10 years ago, they passed a couple of different bills. I don't know why they did it in two separate acts, but they did, for the legislative auditor to look at every credit and exemption, systematically. And it was like 3 a year or 4 a year. And there was like this staggered thing. So that's just, to do that, we'd be repeating work. So,
Or
and
maybe
then I think there was,
we
sorry,
can narrow
please,
it.
Jess.
I don't know if we can narrow it to the credits that intersect with the study that we, what we already are looking at.
I mean, he mentioned like the goal to be, what do you call that? Like solar by 2045 or something, but the solar thing is already dealt with.
State net zero energy goal.
Was that given as an example, or
that's just all these credits that they are just talking about? These are examples. It's not like we are following what they ask us to do. Otherwise, it's meaningless for us to have have this commission, because we are very independent. But that's what they said is what's in their mind, and they think the direction should be. But we, as a very independent commission, we should follow our what we come up with. But that's what we're going to present to them, and then we will tell them what we have done and what we achieve. So I think everybody experienced the last time at a hearing. So when they ask questions, why we are not able to answer, that's because we were not prepared and we didn't know what's in their mind, and they would ask this kind of questions. That's why I think we start this dialogue, so we can understand what they are thinking and what they think this commission should exist, and why we should study all these and to present to the legislature. So it's just some bridge. I think we need to understand how to bridge this and between the WAM and us.
So they think it's like a standard part, it should be somewhat of a standard part of the commission's job description, each commission to review all credits?
They never said that they would. It's
Oh.
also impossible to review all the credits because there's so many credits, policies, and there's no way we can study every single one, and we don't even have probably the data and the support to study all of that. But that just like give examples. If we want to expand some of the credits and to study and how we're going to present and how we're going to have the outcomes. That's what they want to know. If we pick one credit, for example, say GET, and if we want to, what we are trying to achieve. So what are we trying to achieve? We compare to the existing policies, existing state law. What are we trying to achieve, right? So that's something they want us to think.
May I just, yes.
Go ahead.
Just as an information, just to follow up what Jonathan was saying, that the state auditor's office is tasked with evaluating, but a new law just passed, and that was, legislature's bill HB 2429, which was signed into law by the governor as Act 160, and it's called Relating to Tax Expenditure Evaluation. So this is a new law where DBET has been tasked with evaluating every single tax credit and GET exemption. So in addition to the state auditor's office, the legislature now has tasked yet another department to do this very thing that was communicated to you, Judy.
Okay.
Just saying, putting it out there, and then when it's time to give an update about the consultant work, they also have a proposal about tax credit evaluation, but I'll wait until we have that next agenda item. Sorry, Mark.
Yeah, so no, I think what I was gonna say dovetails with what you just said, Baybars, which is I don't think we have we don't have the time or the resources to go through the substantive analysis of, let's say, state energy credits, like, is that going to help reduce carbon? I mean, we just don't have that bandwidth to do. I do think what we have, though, is what is the process that one should go through when you enact a tax credit? Like, what's the support? What's the frame that you evaluate on? Is it a return on investment? Is it, and then that return, how do you quantify that return when you've got both hard economic data as well as soft political objectives, right? So I think it's putting a way that ideally we can work with DBED in defining that method of evaluating tax credits. But in terms of figuring out whether an individual tax credit is worth it, I think we just don't have the time or resources to do that. But if we can work with DBED to maybe endorse an approach, which is more than often, I think, what happens with some credits, which is more, we want to help, and tax credits are less visible than an outright dollar appropriation to help the same thing, even though it's, I think, financially the same exercise. People are a lot more sensitive about dollars being spent as opposed to tax credits being granted. To me, they should be the same analysis. And, I think that could be a helpful role on our part. I just don't think we have the ability to do individual tax credit or even on a substantive way to really address it.
Yeah, I think that we can talk about this when we get to credits. I think there's a fundamental question we got to answer, which I thought I kind of have a sense that we already answered it, but versus, looking at a credit, this credit, that credit, and saying, is it doing what we should do? Would it do? Should we repeal it or not? Versus coming up with a framework or something that like DBET might endorse or that DBET might steal from our report and actually use or something, or they might amend the law to DBET to use something, something from our methodology. Sort of instead of picking winners and losers, try to come up with the best, most objective way for somebody else to pick the winners and losers rather than pick them ourselves. That's a debate we can have later if it's necessary. But I stole from John. He's unmuted. Do you have something to say, John? I'm sorry.
Oh, no, I just turned it off in case it.
All right, cool. So we can totally come back to this at any point. Judy, is that the end of your report when we started? Or did
Yeah,
we
that's
cut
the
you
end
off?
of the report. Yeah.
All right, cool. So my report from I met with Representative Todd just last week. My report is the polar opposite. And I didn't know what Judy's report was going to say till y'all did. But I met with Rep Todd for about 20 minutes in person, and he had several, him and a few of staff there. And I just, gave him what our priorities were, what we'd been looking at, kind of where we stood, and the big things, competitiveness, TAT. We've been studying regressivity, and a couple, pensions and single sales factor, the stuff we're looking at. And he seemed pretty hands off. And so he didn't seem to have much of an appetite for, continuing communications or anything. They didn't have, him and the staff didn't have a lot of input. They mentioned a little bit about, what would be politically feasible. But in the same sentence, they were basically saying, don't worry, that's kind of not what y'all are supposed to be worried about. So that was refreshing to hear. And then the other thing was one of the staff said that, the report from the TRC does kind of help us justify positions and stuff like that. So that was cool to hear. It's not just a stack of paper on the desk. So that's my report. It's the polar opposite of Judy's report. I think we got a lot more to think about from Senator Dela Cruz's interaction than from Rep Todd's. Any questions on that? Any reaction to that? Super straightforward.
Yeah, it seems more reasonable, I guess. I mean, it seems more aligned with what we thought was going on.
And my other reaction, I guess, that I never gave to Judy's thing was like, I don't want to triple our workload here. I don't want to have to try to dress up a draft or two as we go to try to send them to, to the staff and stuff like that. I don't want to get, I don't want that. I don't want that to happen. But we can brainstorm some milestones and, intermediate steps that we can report. Whatever we do, we'll send to Rep Todd as well, just to make sure we.
For what it's worth, I thought it was interesting that CNBC, the DBED tried to get a bill through that would require the state, basically require the state to monitor the CNBC, rankings for business. How supportive are states in terms of providing, supportive business environment. And Hawaii ranked dead last out of the 50 states. Just came out a couple of days ago. KITV, I think, ran a story. So to me, that really dovetails well with our state competitiveness focus. And probably, you know, I think maybe is more, therefore maybe more important work for us. I think tax credits also important, but I think the state competitiveness, when you got CNBC saying we're the worst state in the US for business, is a problem.
Cool. Thanks for reminding me of that, Mark. I saw that on CNBC this week or last week. Last week. Cool. Any other reactions to that, or should we move to the next thing? I think some of this will come back up as we discuss other agenda items, and that's invited. So not cutting everybody off, just moving on to the next one. Keep it going. All right. So I think we'll have to brainstorm and consider some next steps from that for sure. And that might kind of reveal itself over the next hour and a half. Next agenda item, though, is update from the evaluation committee about our hiring of a consultant, or at least our trying to hire a consultant, and the procedural matters or anything like that. So that'd be Judy, Mark, and Bybars.
Right.
I think Bybars has the most recent.
Right.
Yeah.
Right. So we didn't get a chance to, we didn't formalize an agreement yet, but it's in the works. It's just on the UH side, it needs to go through our legal team, and then it needs to go through our legal team and all of that. But there was I'm hoping by next meeting, I mean, first of all, Mark, Judy, and I will negotiate and come up with an agreement, hopefully pretty soon. I was hoping we would have it by this meeting, but we don't. Just to give a little glimpse, we have a preliminary proposal, but I don't want to share details yet because it's the evaluation committee has to look at this and talk with the just to give I guess a sneak preview that Dylan Moore will be the principal investigator. He's an assistant professor at University of Hawaii and is part of UHERO. And then a new faculty that they just hired who will start in August, Nicholas Lacoste, also expressed interest and will be supporting. So they have a pretty strong team to be able to work on this, and they'll be actually able to pick certain tax credits and do a fairly rigorous analysis and be able to address the questions that the commission were asking and in a timely manner. Just so I don't have details. I just want to say things are going well, and then it's something that both Mark, Judy, and I will have to discuss and then meet with them. But one question that I would have is, and they said they're happy to give regular updates and make presentations, not just the final product, not just the draft, which I think could be useful. So that way, like, commission is involved, earlier on in the process. Would it be helpful for let's say Dylan to talk about their proposal in the next meeting? Is that something that would be of interest, or is that something that Mark and Judy should present instead? So I don't know. So I'll just leave it out there, but we can ask.
I think it'd be good. I mean, to me, the key to a good consulting relationship is really being hands-on, as opposed to just sort of delegating it to a consultant and they show up 3 months later with a draft report. So yeah, I think that's a great idea by Bars. The other thing is just, I am a little concerned about their scoping of the project. I mean, it seems pretty broad, does the state tax system serve the people of Hawaii? I mean, that's a pretty wide scope. and, you know, who pays for it. That's really a, you know, you're getting into kind of regressivity questions. I'd rather have them be more focused. I mean, some of the things, if it's a wide engagement or a wide scoping, is they're going to redo stuff that's already been done before versus what I think, you know, is really a priority, which is like looking at how Hawaii compares with the other 49 states.
Right.
And you know, specific ideas on how the tax system can help economic growth here and incomes. I mean, that to me is the front and center question, as opposed to, you know, is this a more general thing about how good the tax system is.
Right. So those details we should definitely discuss. That's why I didn't want to share. I mean,
yeah, no, I agree.
So it was a little premature, but at the same time, I didn't want the commission to think that the work is not ongoing. It is there. It's moving at the hopefully to meet all the deadlines and in a reasonable manner.
Well, if I can suggest, by bars, maybe Judy, you and me sit down with what the current draft is of their idea, and really sit down with them and point them in a more targeted way.
Okay. Yeah. So I'll set it up and and soon. So just I'll send an email to check your availability about that, and we'll start working on it right away.
All right.
That's all I have.
Okay. I have some reaction to that. Anybody else got a reaction to that? I won't cut anybody off.
Just
Jessica, please.
Question. So, if we get a presentation from Yuhiro, I guess, does that then, I mean, assuming that's a month from now, and then does that like then push out what they do to beyond that, or where does that hit the timeline, I guess, of this project getting moving?
I think they get started right away with Mark and Judy's guidance and direction. So I think
So it won't affect, like, it won't delay anything or anything.
No.
Oh, okay.
No, it's more about hearing from them instead of us telling what they're gonna do.
Okay. Yeah. Great. I just didn't know if that was like,
that was my suggestion. I mean, I didn't ask, but I'm pretty. I mean, these are academics. They regularly make presentations all the time, so I'm pretty sure they would be fine.
okay, cool. Yeah, sounds good. Thanks.
If we could set up the meeting with them, let's say within the next, you know, by the end of next week at the latest.
Yeah.
That'd be great.
That would be great.
All right.
Ideally, maybe by early next week.
Yes.
All right. Any other reaction to that, or anything to add to it, Judy?
No,
All
I'm
right.
good.
Cool. Well, I like everything I heard about that. I am in favor of having them show up at the next meeting and you know, hear some of their stuff. And that could be vetoed if you know, the evaluation committee, I'm glad they're there, and I want to have that sort of focused 3 people, you know, work on that. I'm glad to have that delegated. So if you don't come to some term by the next meeting, you could veto that if you don't want them there, like trying to lobby the rest of us or something like that. But I just don't see that happening. I see there being a positive meeting next week or whenever it happens. And, hopefully, it depends on when we schedule the next meeting, they can help us. And this is kind of what I meant earlier. Like, so if let me know as soon as possible if Dylan or somebody from Yuhiro is going to be there at the next meeting, and I won't try to schedule my targeted regressivity speaker for the next meeting, because that'd probably be too much for one meeting.
I'll let you know as soon as possible.
Right. Okay, cool. I think that's good news that it's moving forward with UHERO. And I was looking at the dates. The anticipated contract date on the thing that we posted would have been July 15th. So that's tomorrow. But I think they've put together an entire, the document that's there that y'all are going to work on next week already. So I think that's sort of similar to having a contract date in the neighborhood of July 15th.
Yes,
Because they could probably be doing, preliminary work even now.
correct.
Even if the scope does get dialed in next week. Really, really good. That's two meetings in a row. I've been very happy with the developments on that. Cool. All right. Anything else on that subject? All right, cool. So the next one is getting into the substance. The main getting into the substance. So the main one was the pension or retirement income situation. And I saw earlier today there was a set of slides. 5 hours. Was that something for information, or was that something you're going to present to us? I wasn't sure.
In the last meeting, you had asked if there was something that I could provide just to get the discussion started. It's more informational.
Okay.
Nothing, no opinions or anything in there. I'm happy to talk about it very briefly if you are okay with it, or you can just lead the discussion, whichever way you want to go forward.
Okay.
But I was asked last time to bring something, so.
Cool. Thanks for bringing it. So I indicated last time that I was going to look to John and probably Jessica too to lead this one. So John, do you want Bars to walk through his thing, or you want to just go for it?
No, I think it'd be helpful. I did take a quick look at it, and I think it'd be a good starter into our conversation.
All right, cool. Bars, proceed.
All right, I'll keep it very brief. So as John and Jessica will talk about, under current law, the Hawaii law, if the retirement income is funded entirely by the employer and it's qualified as a pension and profit sharing, it's exempt from the state income tax. So this mainly covers, for the most part, the government pensions at the state and city and county level, and some federal civil service and military retirement, and some other qualified employer-funded pensions as well, and even private defined benefit pensions, but that's definitely a much smaller minority. And the big chunk of this, the employees' retirement system, that affects this state and local employees, and currently they have about 57,000 retirees and beneficiaries taking advantage, but they have 66,000 active members, and there are also those who have with vested interest. They're not retired yet, but they're inactive. They moved on to other jobs, but they will qualify at some point to receive these retirement benefits from employees' retirement system. And in the past, as was discussed, there was a non-contributory plans, so that the employees did not have any deductions from their paychecks to contribute to this. In the last couple of decades, it's moved on to what we call hybrid system, where employees make a certain amount of the contribution, 6 to 8%, and then that is taxed by the state. Although it's not taxed at the federal level. So there's an upfront taxation of the portion where the employees contributed, but not the part where the employer contributes. So let's say the employee contributes 6%, the employer contributes 16%. That 16% is not taxed, whereas the employees' contributions are taxed. And the issue that comes up, and as I'll mention, when we think of retirement income, mostly from the private sector, we kind of think of the 401ks, the traditional IRA accounts and whatnot. And these are fully taxed when they are withdrawn after when they're withdrawn and when they're distributed. Yes.
Can I interrupt you for a second?
Yes, please.
I'm glad you said this before I interrupted you. But before on the last slide, when you said the 16%, doesn't get taxed, but that 6% employee contribution does get taxed.
Correct.
Is that the mechanism there is because that's income to the employee and there's no deduction for that contribution, right?
So
that's why
it's not taxed when it's withdrawn at the state level, but
right.
A portion of it is taxed. So it's not the case that it's never taxed. So at least at upfront, at the contribution stage, it gets taxed by the state. When it's distributed, but it's not taxed federally. At the federal level, the distributions, when you start receiving your pension income, that is taxed at the federal level, but not taxed at the state level. So part of the retirement income that you're receiving would include your own contributions, like the ones you would have made to a 401k, but it also includes what your employer, in this case, for me, for instance, the state of Hawaii's contributions will not be taxed. It's the state itself making contributions and then paying it out, and then they're choosing not to tax their own contributions, basically.
Right. The only reason I bring it up is just because I think sometimes, like in pop culture, it's like tax-free pensions, but the contribution made by the employee, at least for ERS, because ERS it's a contributory plan now, that is taxed up front. You don't get a deduction.
That is
for federal
correct.
Government, federal you get a deduction. State you
correct.
do not. So
correct. So it's not fully tax-free. So thanks for that clarification. So that was definitely brought up in the previous Tax Review Commission. So this is an issue that has been recurring in like the 2001. 25 years ago, the commission suggested that there can be a repeal of this retirement income, but it should be phased in, and that it should not apply to persons who retire before that phase-in period, in order not to penalize the current or prospective retirees who have made their financial plans based on exemption of such retirement benefits. The 2005 commission, the next one, suggested something more specific. They said, okay, let's have a base amount that will be excluded to mitigate the effect of this change on those who will be receiving tax-free pensions. Also, it would kind of remove the negative effect on those who receive relatively smaller pension income. A bit of equity and fairness arguments. And then the 2015 commission suggested full conformity to the federal, and then they just suggested 5-year lag. That was the main thing. But the last Tax Review Commission, where Jonathan, you're aware of, that they did recognize the fact that there should be deductions allowed for contributions that were previously, to previously untaxed pension plans. So as you mentioned, this would be double taxation otherwise. So if you were taxed already when you contributed, and then you get taxed again when you withdraw your pension income, it would be double taxation. So this would have to be addressed. But the problem also with that is that, let's say you're very close to retirement. In a few years, you're going to retire. You've already made all these contributions. You've already been taxed. And the moment the law changes and you withdraw your pension income, you would still be subject to this double taxation. So for that reason, the previous Tax Review Commission suggested maybe exempting a certain amount again. They looked at 25,000. They looked at 50,000. This would partially alleviate this double taxation problem. Just to give you an idea, who are the ones who claim these? So there's about a good chunk, about 8.9%. Well, it's more than a good chunk of 110,000 in 2019 data have some pension income as part of their income in Hawaii. The biggest chunk of that is, not surprisingly, qualifying surviving spouses. So this is someone who can file jointly, and if their spouse has passed away within the last year or two. So presumably they would have some death benefits, and that's why they're more likely to have this pension income. So that would be that's why they are the largest group with the that it is showing pension income as part of their Hawaii income. But tax-exempt pension income is reported in 17.5% of resident returns. So it is a big chunk. It affects quite a large number of people. If you look at just Hawaii AGI, since it's not considered as part of Hawaii AGI, pension income is not included Hawaii AGI. We would see that the ones with the pension income in the lowest income groups. But if you look at it from the federal AGI perspective, which is federal adjusted gross income does include both Social Security benefits and pension income. So we see that it's more of middle income folks in general, like the way you would describe people with pension income are a bit more middle income class. So in the last Tax Review Commission, I was asked to do several simulations and look at the revenue impact and distributional impact of different proposals. What if we repeal, the tax-free treatment of pensions? What if we repeal both pensions and Social Security benefits and exemptions? And what if we give a $25,000 exemption amount and all of that? The issue has been that overall, it's more or less increases regressivity if we do that, but it also is a balancing act. The past Tax Review Commissions looked at also the unfairness of it from the perspective of those who only rely on like 401k type of retirement, but no pension income retirement. So there's a bit of an equity perspective there that was also considered. But removing the tax-exempt status of pension income and Social Security income, or both, would increase the regressivity of the individual income taxes, was the conclusion. This is just, again, to give some background, but I leave it to John and to lead the discussion. Thank you.
Well, thank you so much. That was helpful. I had one question, Bebars, on the slide number 9.
Mhm.
It says married filing joint average pension income 44,000. That's for the joint. So for two people.
Right, correct. So their average pension income for both 44,000. So it might be just one of the. So we don't know which one. It might be maybe both have pension income, but the average amount of pension income was $44,000 for married filing jointly.
Okay. So I had a chance to, what I did was in lead up to this meeting, what I did was I took a look at other states and kind of wanted to see what other states do. So apparently 16 states fully exempt pensions. Of course, 9 of those are states that don't have income tax. So there's just 7 other states that have some phase out or some non-taxability or partial taxability, I should say, of pension income. It goes across the board. A lot of the states that do tax pension income, their max tax rate is very low. So we're talking, 4%, 5%, 3%, versus Hawaii, which goes up to 11, now 13% for the $1 million people, So I guess the discussion is, and I don't know, Baybar's talked a little bit about the fairness of people with 401ks or IRAs, traditional IRAs. I would think something like some form of an exemption would be good, in the sense that it would kind of combat that regressivity. Because what we're trying to do is help the lower income people and see if we can shift some of that burden to the higher income taxpayers. What that number is, I don't know. It's kind of helpful to have this because it looks like we're looking at something like 30,000, maybe a person or something to that extent, 60,000 for a couple, maybe more. I don't know. Some states, what I looked at, like Georgia, they exempt 65,000 for a joint couple if you're over 65. And some states are really small. I mean, they do 10,000, 12,000, 6,000. So it really depends. But I don't know if anyone had any thoughts. I also noticed another thing with this on this Social Security. Some states actually do tax Social Security when they hit a certain income level. So, for instance, like New Mexico, when you hit 100,000 single, 150,000 married filing joint, it starts to tax Social Security. So, I mean, that's another revenue raising idea. I don't know, but if anyone had any thoughts, I got some numbers here. If you got any states or any, of course, states like California, they're brutal. I mean, they tax everything, 13.3% max rate. So California clearly not something we'd probably want to model. But I think the reason I brought this up is just on a pure administrative basis. If we come up with some exclusion, be it what it is, 50,000 a person or whatever it is, helps the department with administration. Right now, we don't need to know if it's employer funds, employee funds, because quite frankly, a lot of the returns I see they don't do it right. I mean, they exempt everything anyway. Nobody fills out Schedule J. I mean, I don't know if people know what Schedule J is, but I just something I threw out. So if anyone had any thoughts,
Yeah, thanks, John. I do. I think that I don't know. I feel like this study and how it like worsens regressivity. It seems focused on the government pensions, the impact to people with government, federal or state pensions. But I think what we're trying to get at is people with the IRA 401k, partially employer funded, partially employee funded, that don't, where a chunk of it is taxable for Hawaii purposes, because at the upfront they did get a deduction for Hawaii, so they are supposed to be paying the tax, but nobody goes through the exercise and everybody just thinks, oh, pensions are tax-free in Hawaii, all pensions. And then, so I think the state is just losing a lot of money with people on that assumption. So we're not trying to make a government, I can see this whole thing about double taxation and people that have paid it up front and now we're going to make it taxable. My thought is that we're not trying to make government pension or any kind of fed or state government pension now taxable. And with like say a dollar amount exclusion, I would leave that as is. So to the extent it's federal or state pension, yeah, it's non-taxable. But when you get into a pension that's not fed or state, then maybe it gets a whatever blank dollar amount exclusion rather than the whole thing being non-taxable, because there seems to be a lot of lost funds to the state from a lot of tax preparers that believe that all pensions are exempt, but it is only exempt to the extent it's employer funded. So not any attack on the government, guys. Those I would leave them as is, so that there's no, because that's always going to be a hard thing to just suddenly choose a year and from here forward their employee contributions are now taxable. I mean, that's just going to be a mess, I think, because they've always been taxed. So leave fed and state non-taxable, you know, leave that. But when you have, yeah, like 401ks and IRAs, if they're not fully employer funded, then they just get a, I don't know, dollar amount exclusion, or maybe it's something to simplify the calculation, that in lieu of a calculation, you can just take a dollar amount or something like that. Just to bring
Administratively,
it to
yeah.
light, because I think like John said, I think everybody's, not everybody, but a good chunk of preparers just do pull out the entire pension. I've seen it, like John has seen it. Like, you get tax returns from other preparers and they're like, when you look at it, you're like, well, I don't know if that whole thing is, you know, employer funded, and then you find out that's their 401k. They put aside those monies all their whole whatever career, and then they're taking it as fully non-taxable when that's all they've been, you know, allowed that deduction for Hawaii also their whole career.
So if
Oh.
I understand, Jessica and John, this is, at least on the private side, it's more of a collection or enforcement problem, or a miseducation, I mean, or lack of education, as opposed
Yeah.
to law itself.
Right. So the law says that, yeah, I mean, it's only to the extent it's employer funded. So to the extent that you've put aside in a 401k in your employment career time, and now you start drawing from it, it's taxable for Hawaii if you put it away, if the employee put it aside. But nobody bothers to go through that. I mean, because there's usually some employer matching component, and then there's a schedule you're supposed to fill out to calculate it. And it's just not a popular schedule, you know? And so there's just a lot of money left on the, I mean, yeah, it's just, I think possibly the state is losing. I don't have, like John,
But-
I don't have a dollar amount, you know,
Yeah,
but I've seen it come to my desk, and like from a previous preparer, and it's like, oh, they've exempted the entire pension or the entire 401k or the entire 1099-R. And
So I guess, how big of a issue is this in terms of total revenue loss to the state?
yeah, I have no idea. That I have no idea.
Well,
But
shouldn't the investment company, they know when they contributed to that IRA account? For example, how much was employee contributed, and shouldn't the investment company, they actually know, whoever issued the 1099-R, they shouldn't know that, right? If the taxpayer just go back to ask them, can you tell me this pension is state exempt, or is it partially exempt, or is it taxable? Wouldn't that?
So the problem you have with that is, this is Hawaii law. So if you have a investment advisor or someone out of the state of Hawaii, they're going to tell you, why do you need to know that? And the other problem you run into, Judy, is, you know, when you have, you know, some guys have 4 or 5 jobs and they have 4 or 5 401ks.
They don't talk to each other. Yeah,
all in
they.
one IRA. It's a disaster. So what I generally do with my clients is I have them break apart employee and employer contributions into IRAs.
yeah,
But
so you
yeah,
need
most
that.
people don't.
Usually
Yeah.
it's a more sophisticated taxpayer who will intentionally split their employer and employee funded pieces, so that when they withdraw it, they know, I'm going to pull the employer funded, so it's exempt, or I'm going to pull the employee. But those people are very few. So the majority.
I agree. Yeah, I agree
Yeah.
with you, Jessica, because I do see a lot of people, they just ignore that and they just ended up completely exempt, which is not correct.
Yeah,
So,
and they probably can't even figure out the numbers to put on the Schedule J to
Right.
figure it out. And so
That's the main
it's
thing.
like,
Yes.
oh, you know, the unwritten rule is you just exempt it all. So
Yeah.
just exempt it all. So it's kind of like, to address this administrative burden, when you have an withdrawal from a pension that's partially like a hybrid employer-employee funded pension, that there's a blanket dollar amount.
I think this is
exclusion.
also a issue from the state side, because how are they going to audit, right? How are they going to audit the taxpayer? What portion should be taxable or not taxable?
Yeah, because a lot of times the information is not available.
Right.
Yeah. If it's old,
So it's just an administrative issue. And so to help the administrative issue, put a dollar amount for non-government pensions that are hybrid employer-employee funded.
so basically an easier way to figure out what should be paid.
Yeah, so like if you don't know and
A
you don't have the
formula or
numbers,
something.
Yeah.
But it would be great to understand how big of an issue this is in terms of the state budget. I mean, is there a way to model this by bars that you could just take some assumptions of, you know, private pensions and assume some dollar amount off of that?
Yeah, I mean, we don't have data for sure, but it would be an estimate of something
Or-
along the lines of what you're suggesting. Using trying to use federal data probably is what I would do. Because at the
And when you get
federal level,
1099Rs, there's nothing, I mean, it's just could be anything. You kind of have to ask the taxpayer what
Yeah,
it's from.
you can tell from the 1099 hour. You can tell. But I guess the suggestion probably would be, can we simplify the rules so we don't have to do this calculation so deeply, and most of the taxpayers, they are not educated on this. So can we simplify the tax law to make it more standard or easy to understand?
Yes, because like I just did a quick, like a Google on like Georgia, right? So they tax government pension. So they have a flat, like, whatever larger dollar amount. But let's say, our law will be like that, yeah, government, to the extent you have government pension, tax free. Okay. If you don't have a government pension, to the extent you have a non-government pension, partial employer, partial employee funded, X dollar amount. So it maybe doesn't need to be 50,000, it could be 10 because, or it could be a range. If the gross is this, then the exclusion is this, or I don't know, a moving scale or something. But I think it's to try to address this calculation that should be done, but I'd say 90%, if not more, of the time is not done. So to just, help that. And then like when you have this new law, then people probably who were not aware of this, taxability would be like, oh gosh, okay, I get it. Now I'm gonna make it taxable, but take 10 grand out or something,
Yeah, I agree with all that. I think it'd be helpful though for the ledge, if you're going to propose, if we're going to propose something along those lines to at least quantify what the tax revenue impact is in some way, maybe with a sampling. I mean, is it possible to sample, some returns and extrapolate from that? I don't know, but just it'd be helpful to understand the revenue impact behind this, because then whether this is really urgent or like if it's potentially hundreds of millions, I'd say it's something we should look at, high priority. But if it's single digit millions, it's not so interesting. And then I'd say the other one, which is from the equity standpoint, is it fair not to tax? If you're going to tax private pensions, why don't you also tax in some measure government pensions from the equity standpoint?
Yeah, I think there's, go ahead, John, please.
Yeah, so that was one of the comments while saying, like, we could come up with a number, maybe 50,000 per person, 100,000 joint, or because yeah, I mean, there's an equity issue because Hawaii's, we got a lot of union guys here too. They're gonna say, what the hell, now you're gonna tax my pension, versus and let the government guy. So I don't know. I don't know what the right answer is. I think, Mark, going back to your comment, I think you can probably, I think Baybars, what they can do is you do have to detail the piece where the money is coming out. So if you could data mine, take out ERS and DFAS, because we know those are government pensions, and everything else would probably fall in Morgan Stanley, whatever. Those might not be government pensions. So you can figure out what's government, what's non-government.
yeah, I mean, so this is the kind of stuff that we on a regular basis do, my office does. So if we have actual data, we use the actual data, tax return data. If it's not there, then we have to go to the secondary sources. Okay, how much does ERS distribute in a given year? And then extrapolate from that. Okay, how much are taxpayers claiming exemption for. Yeah, so this is the kind of stuff that we do, and that would be in the equivalent for my office for sure. But I would also tell you what the assumptions we're making are. Another approach is what I mentioned, so you might have some insight about this. How about the federal level? I mean, so you're saying that at the federal level they're paying, right? Because the 1099 automatically withholds any distribution, right? Whereas at the state level, there's no withholding. I mean, now, or it's not automatic. I mean, the taxpayer might choose to have some withholding. But you're saying that they're claiming this exemption, whether there's withholding or not, at the state level, right? So at the federal level, we should know how much pension income is taxed, at least. So my other approach typically is if I have federal statistics, like what percent of income is retirement income and how much of it is taxed, and what is it in Hawaii, and then kind of what would that difference be? So there are ways, I guess. So that's the kind of stuff that we do on a regular basis. Again, if that information is not in the tax return, in this case it's not, we don't know how much of the income that is in a tax return is from a 401k or if it's from a wage. So the reason for that is our tax returns start with federal AGI as the starting point. So all those levels of details are not captured in state tax returns because we do not, at the federal level, it matters because, the taxation of retirement income, Social Security benefits is a thing. So they need to know how much of it is from interest, how much of it is from. So that might be another thing that maybe we would need to collect more information, but currently we don't have that information. So my second best approach would have to be relying on those secondary sources and coming up with an estimate. And that's what we typically do. It will be, are we talking about $100,000? Are we talking about $50 million? So that kind of thing is definitely something our office can provide.
Yeah, we'll need a number, I think, kind of on something like this.
Exactly.
Sorry, Mark, your body language told me you're about to say something.
Yeah, I'm a simple-minded person. So why don't, is it stupid just to conform it to the federal code? I mean, if the feds are doing all the work anyway, and I mean, wouldn't that be an easier way instead of a separate tax regime at the state level for pensions?
I think the kupuna would, put you on a bullseye.
Yeah.
But
So
I
this is
think
like
there's
the-
a lot of government state, I mean, I don't know
Okay.
that we can suddenly make
So-
all their pensions taxable. I think we're just trying to get the people to align with the state law as it's written, to be more compliant, but because of the administrative,
Got it.
challenges to it, just, maybe step one, try to just get the guys that are maybe not exactly compliant, and then maybe we can, I don't know how that's gonna go over.
Got it. So this is like
Yeah.
Social Security reform, as someone in Congress said, it's the third rail where you get electrocuted if you try to fix
Yeah,
Yeah,
that's
it's like the
that's
third
yeah. That's electrocution, I think. Make it all
Yeah.
taxable.
So the other question I had, obviously this has been a hot issue for the Tax Review Commission for the last 25 years. What happened to all these other efforts?
Nothing.
Okay.
It's the white whale.
Yeah, the equity question. I mean, to me, there's two questions. There's the equity question, and then there's this administrative question. The equity question, it requires a huge run out, which is why last time what they wrote up was, 25 years. You work in the deduction over the 25 years. You don't, basically, you're not touching anybody with real cash for 25 years or something like that. And so it's just. But then if you're allowing that deduction looking forward, you're actually taking a tax hit up front in the year one, I think, but you're not taxing any pensions, you know what I mean? So it's rough. With the run out is kind of necessary, but the the other admin question about the number, I would say is it's basically like a rough justice number is what y'all are talking about. And then I would say, I would add to that the rough justice number or the detailed thing, because if somebody's keeping the records, then they should get credit for that. So like say the number's 20,000, but they've got records that show 50,000 or whatever, maybe they should get the credit for the 50,000. So maybe it's either or, like,
Yeah, like in lieu of,
So-
like, if you have the info, fill out the Schedule J. If you don't, then this is the
Yeah.
max exemption you're gonna get.
yeah, and then the department could basically put in something that would like kick out any Schedule J with any number lower than 0 or number higher, or sorry, number lower than 20 or higher than 20, whatever it is. I haven't looked at the Schedule J, but I don't know if it'd be higher or lower, but whatever, a number that doesn't match would kick out that return for a letter or something. That's what I was gonna say. All right, Stacy's been quiet and she's unmuted, so I'm calling on Stacy.
No, I'm just following along the conversation, but that, I think what you just said kind of makes the most sense. Kind of like a standard deduction versus a itemized deduction concept. Because I think when earlier in the conversation, I was thinking, well, if it's taxed by the IRS, then the people who are claiming it as non-taxable as the state of Hawaii are having it, considering that you start with the AGI and the Hawaii return, they're actually having to intentionally exempt it, right? So there is a process already. So administratively to address how they're doing it is our opportunity, I think, to capture the tax, push people into compliance. Sorry, I'm kind of just thinking out loud, but I do think how would we, I think that what you just said though, that identifying what that rough justice number would be is that sounds like the best compromise, but coming up with that number is challenging. Maybe make it low enough so that people will be more compelled to fill out the Schedule J.
I think you're on mute, Jonathan.
Thank you. Anything else on this topic? All right. So it's getting late, but why don't we take a break for 10 minutes or 12 minutes, let's say, 3:30. And so come back at 3:30, and then I'll re-prompt everybody on this in case anybody thinks of something in the break. If not, we'll move to talk about credits and exemptions and stuff, or whatever y'all want to talk about. So we'll pause the video, and Rick will pause the recording or do whatever he does. 3:30, no talking about commission business in the break, and turn off your cameras and mics. Thanks.
Please go ahead.
All right, we're back from our break. So before a break, we talked about the pension income thing, and I don't want to cut that off. So any other thoughts on that, or final thoughts? It's not the end of this for sure, but we can continue that now if y'all want to. All right, cool. I think we got enough to chew on. So why don't we make a start at the credits and exemptions problem. I stated earlier, I'll tee this up a little bit. I think there's two, just like with the pension thing, there's the equity question, and then there's the sort of compliance question. With credits and exemptions, there's the substantive question of looking at credits and exemptions, this one or that one. And then there's this overall more holistic or objective question of how to look at one when you look at one, or how to look at two when you look at two, or whatever it is. So I thought that we would be focusing on the second of those, which is kind of the how to look at one. I think the way it was put many meetings ago is a framework for evaluating credits and exemptions. So is that, does that ring a bell? Or am I completely off?
Yeah, no, I think that's right, Jonathan.
Okay. So we don't have a ton of time. So I don't really know how to proceed here. I wrote down some of my thoughts in a document. So I'll give a little bit of this, but I'm not trying to steal, but or take this topic away. But basically, I think as far as the framework goes, like looking at these things, I think to me the first step is to split them up into categories. So I think it would be really weird to be looking at the EITC the same way as you're looking at the film credit, or to look at the food excise credit the same way you're looking at the research credit. So I don't, you could be as granular as possible, but to me there's three categories: social category, the EITC, and then there's economic sort of targeted infant industry category, which is like research credit and I guess film credit. And then economists might get mad at me. I don't know if I'm using these words right, but there's a market correction category that I consider basically correcting a market failure kind of thing. And that the example there would be the research credit. So the output of research is not properly priced in the year, the first few years. So you gotta affect that the input costs to get the right the right amount of output, the socially acceptable amount of output or something. So in that way, the market correction credit looks a little bit more actually like the EITC type credit. But I think that's sort of the three categories. And then if we go from there, we could target one or two or three of those categories to look at. That might be three different sets of criteria or three different frameworks for one for each different category, if those categories even make sense. I'm just trying to start the discussion and tee things up a little bit. So I didn't get very far as trying to draft, write up any actual criteria or anything. I have a few notes here, but not much. So any reactions to that?
It makes, I mean, I like the classification because I think the first group is really trying to make the tax system more equitable, I think. I mean, earned income tax credit specifically. I mean, I don't think of it as certainly don't think of it in the same way as the film studio credit. So, and I kind of think that's not a case where you're trying to stimulate economic activity. You're just trying to make the tax system more fair, and you're calling it a credit, but it's just part of how you assess tax liability. So I don't think that's part of this part. I mean, this thing, it's more around where people are putting in tax credits, I think, as you say, either because the market doesn't provide enough incentives to do necessary work like research, or you're trying to stimulate industries. I would say the ripe area for analysis is probably that last one, because I suspect where the market failure happens, it probably doesn't amount to that many dollars lost. Whereas I think attempts to try to stimulate industry, whether it's film credits, film studios, or the oft-mentioned 221 credits, 15 years ago, that kind of stuff to me is where the analysis really matters.
Okay. I think to me, the categories, I mean, if we can focus on one category, it might simplify what we're trying to do. Simplify the framework. So we're focusing just on those. Will it help to, would it help to pick a credit and then choose a credit and then as an exercise, choose a credit and pick that credit apart and then try to apply that to the rest of them? Or like what is the, we're running out of time, so I'm kind of just trying to set up for next time or the next time. So, so to, just to try to, what's the proper exercise to brainstorm what the framework will be? And like we could grab the 221 credit and start looking at it and say, after the fact, here we can look at this one since it's not there anymore, really, in a different light than a current credit, I guess, to use it as a case study or something. Or we could just start brainstorming next time and I can just write them all down. What do you think, Mark?
Yeah. I think it's a good idea to kind of drill down on one as kind of a case study to then come up with a framework. I think 221 would be good, except I don't know if it's too old and whether there's still data around. Maybe it's the film industry. I don't know. There's also what enterprise zones now. That's still a work in progress.
Mm-hmm.
There's solar tax credits. I mean, maybe that's a fourth category where you're trying to get both. Well, you're actually trying to get non-financial outcome, which is less carbon using a financial incentive. Even, I don't know, even, yeah, so some of the stuff around that. I like the approach. I just don't know which one to tackle, which would be the test case.
Yeah.
I think earlier Barbara mentioned about the recently enacted tax bill, the SB 3125. I haven't read that, but have anybody read what's covered or what tax credits actually covered under that bill?
Yeah, the big thing is solar.
The
And
sunset,
the
yeah.
capital goods.
Solar and then cap goods.
Capital goods
Solar's
tax credit.
gone, cap goods is gone, R&D is gone.
Yeah.
I'm kind of, but yeah, some big ones are gone.
Yeah,
I
I
think
mean,
Phil
this is,
had its own bill.
yeah, I mean, this
because-
doesn't have to be one that's still around. I mean, it could be a credit from 1973 for all I care. It's just a matter of it's a
Oh.
case study to like
Okay.
see like
I think we should
like-
use solar.
all right. I mean,
Well, the solar one's hard because you're trying to well, I don't know how easy it is to measure carbon emissions because that's really what you're trying to accomplish, right?
well,
You're putting in you're investing money by way of giving a tax credit and you're hoping to reduce carbon. I don't know whether you can come up with a framework very easily, whereas film credits, film studio credits, you're helping local production. You can measure, film studio wages. You can measure arguably tourism impact of more tourist dollars in Hawaii and what the taxes off of that are. I mean, there's more of a model there. Whereas the solar one, I'm not sure offhand anyway, how you'd measure that, the benefits.
yeah, I guess this is interesting because this means, I mean, to me, the solar credit might be the triple. It might cover all three categories I covered earlier because the carbon thing's almost like the social category. The econ category is like you're trying to pump the solar industry in Hawaii. So we have a bunch of people that are putting it out there, but that, I mean, that's even closer to the market failure thing, where it was basically not market failure, but like market correction. Like solar was too expensive compared to other means of producing electricity, so nobody do it. So the credit corrected the price. So it's like a triple. So maybe that makes it the worst candidate. I don't know.
I mean,
And
I
maybe
mean,
instead of measuring, or maybe we measure it by, solar installation, or I don't know. Well, I guess how would you get that info too after it ends?
I mean, I think that whichever one we choose, I mean, the idea is that, like, say we use the film credit and the things Mark just listed or whatever, that those will lead to the measurables for the other credits, at least within that category. It won't just be like, here we have a set for the film credit and it's only available for the film credit. The film credit would be, whichever one we choose would just be a case study. It would create these general, is that
right.
Is that right? Okay.
Yeah, that's how I'm thinking. I mean, that was your
That's what I'm
idea,
thinking.
Jonathan, and I agree. I mean,
Um,
bottom line, the way I think about it is like, these are identical to dollar, appropriations. You're just disguising it in the tax system. But
Yeah,
part of me says you shouldn't have any credits. You tax everybody the same. But if you want to help certain industries, just do outright dollar appropriations. You're at the same place financially, but it's much more transparent. And we all know that there'd be way more scrutiny on expenditures than in granting a kind of hidden credit. So what would be the analysis that you would do to say, if you wanted to give everybody outright dollars to help buy a solar panel, what would be the analysis that you would do before you enacted that kind of a bill?
I agree. I think grants make it so much easier. Like so much easier, but yeah.
I mean, that could be our recommendation right there. Don't do any tax credits. Just
Hey,
keep
I agree.
taxing everybody the
All the
same, but
way.
then give dollar grants out if
that's-
you really want to stimulate activity or help social causes, but it'll get way more scrutiny by everybody.
Yeah. I
We
think
can
somebody
make the
mentioned that
framework for the qualifying rules for the grant.
yeah. I mean, if we can come up with the qualifying rules for the grant, that's exactly what we need. And we can just word it as the credit stuff, not the grant stuff. Because the grant idea is a great idea, but it has exactly the same chance of the pension question, the equity pension question, not the the compliance pension question. The other pension, the big pension question. All right. So as expected, we didn't get far on that, but it's started our process of brainstorming this one. So I'm going to continue to brainstorm and fill out this document. I invite anybody else to do so. Write down your thoughts. And maybe you'll start writing down some criteria and stuff as you go. So for next, I want to have time to discuss the next meeting. Any last thoughts on that before we move to discuss in the next meeting? I want to have about 10 minutes at least for that.
Thanks for getting us started.
Yes, thank you.
Can I ask
You're welcome.
to refresh and to frame this, I guess, for our consideration, what is our goal for this? Identifying the framework. What are we hoping to accomplish?
I want to hear, so Mark, you want to go first? Mark, go for it.
Sure. I think it would be basically a checklist for every bill that proposes a tax credit.
Yeah, okay.
You got to show X, Y, Z.
So we would propose, I agree. I think that's a good framing. way to
And then-
frame it. But how would we, what is it? I mean, how would we do that? Is that proposing legislation to require it, or what is the vehicle to do that?
I think maybe it's just guidelines before anyone introduces a bill that they got to do these checks, and maybe the other thing is maybe equally important is that should tax credits sunset 5 years out and only get extended if they, again, so you have to re-underwrite a tax credit every so often using the same framework.
So
Yeah,
I guess going back to Baybars, I think you mentioned that there was another bill, HB something, that gave DBED this task, right? So are we duplicating efforts here? If I mean, if
well,
It's
I'm
different. Yeah. Yeah. Go
it's
ahead,
different,
John.
okay.
So this goes to Stacy's question too. And the reason I kind of called on Mark is because he mentioned framework for evaluating credits many meetings ago. So, but I kind of agree with Mark as far as like a checklist before the bill. But also I think it would be useful as something to look at the existing ones that DBED might pick up and steal from us, hopefully,
In their
Yeah.
analysis.
in their analysis, because they're meant
Okay.
to do the actual analysis. We're not going to do that for every credit. I mean, maybe we'll use our case study and maybe we'll create our framework, and then maybe we'll exercise our framework at a meeting with some other randomly chosen credit or exemption. And if we want to be extra safe, we could choose one from Ohio and do that one to keep from choosing a homegrown one, so we don't look like we're targeting something here, but either way. But that would be the extent of us using the framework, actually analyzing a creditor exemption, or what I would call picking a winner and a loser. DBED's meant to do that, and they might take our thing but years ago they did a law. They passed a law or something that where every credit had to have an exemption, had to have a sunset date. So the difficulty with that is it's the same law. I mean, it's not a constitutional amendment. It's not in the rules. It's just a law. So they can just say, notwithstanding HRS 235 whatever, wherever that law is, notwithstanding, this one's good forever. So it's not, the checklist is, it's not, it's a good question because it kind of highlights that we're threading a needle here. Like recommending a legislature bind themselves is kind of not, it can just be notwithstanding away.
Well, maybe the focus is on rules or guidelines for WHAM and House finance before they approve a bill through committee. I don't know.
Yeah. Okay. Somebody write that down. I like that. I like cascading repeals instead of a sunset at the end of 5 years, say 10 years, and it starts to ramp down after 5. I think that's been done though. It creates that cliff repeal creates a real lobbying point that gets some extended, notwithstanding the sunset date. More to come. All right. Anything else? Everybody's unmuted, so I'm scared I'm cutting people off. All right. More to come. So plenty more opportunity to talk about this and the pension question. But we got to talk about the next meeting. So next meeting, hopefully, I hope we're going to hear from Yuhiro. I don't know how long that will take, but I'm willing to let it take as much time as it needs for questions and stuff from them. It's important. And then I'm not going to pursue a speaker on regressivity for next time. But for the agenda, should we have, do you want pension and research credit on there again to revisit those, or you want to, what do y'all think? We could let pension sit for one meeting, or we could just get right back into it next time while it's fresh, or we could spend some time on credits. I'm kind of agnostic. So if y'all don't have a strong opinion, I'll make something up. Me and Judy will make something up next
For-
week. Go.
For the pension discussion, does more work need to be done?
Good question.
And is that Baybar's? I don't know. I mean,
So that's a good question. That makes me lean toward skipping it next time and talking about credits and exemptions. That will give Bybar's office extra time to.
Well, do we know what, are we giving Vipers an assignment though at this time so that we can skip it next time?
Yeah, I think the idea is the number,
Yeah,
the
what would
relevance,
that number be?
relevance number, or is the number I guess I would word the assignment like it can be the number or it could be evidence that the number is relevant, evidence that the number is bigger than nominal. And so that I just don't know if that's enough, or if we should just talk about this next time to try to dial in an
Yeah.
assignment to buy bonds.
Yeah, I think so.
Okay. All right. So I'm going to put them both on there. And then I'm going to put single sales factor on there as well, just in case we have time. And then we might limit the pension discussion to getting an analysis question for Bybars. Or we might just go into it. All right. Cool. So let's get our calendars. Now it's the hardest part. So given I'm still happy with monthly meetings, so looking at August around this time, and my August is just wide open. So if we stuck with like the monthly thing, that'd be August 11 or August 18. So I always forget, so I'm gonna ask Bybars and Rick first. Is that?
Yes, that works for us. Either day.
So that's the week of, essentially that's the week of the 10th or the week of the 17th. What do y'all think? Does the 11th at 2 p.m. work?
Yeah, it works for me.
All right.
I can make either of them work.
Okay. John, is that a nod?
Yep, either day's fine.
All right, cool.
I think the 11th is better for me.
Okay. Neither one's better for me. So let's do 11. So August 11 at 2 p.m. Virtual meeting like this. And then
Is Jeff gonna join us?
yeah, we'll check with Jeff.
Yeah.
Yeah, I hope he'll be available. We'll reach out to him. I
I'll let him know.
suppose.
Yeah.
Okay. Yeah, I mean, if he's got something he cannot make that, let us know by bars, and
Okay.
we might try to we'll see what we can do as far as some, I think the notice is the notice, not this meeting's discussion. So I don't think we're like sunshine law bound by this discussion. So we could change that as long as we give it 8 days notice, or 6 days, whatever it is. All right. So next time, when we break to or stop to talk about the timing, I want to start talking about, or start timing of the next meeting. I want to start talking about like several meetings out, and possibly that last meeting, that December meeting. So just to be, if you can, be ready to with whatever you got for the next couple months, and especially in December. The report is due on December 21st. That's the actual due date. So, a meeting before that to finalize everything and cross all the T's, dot all the I's. I want to make sure we have at least a very minimum a quorum at that, right before that. And then it is going to accelerate. So we're going to end up with like once every 2-week meetings and stuff like that eventually. So
Do you
and
say December 1st?
December 21st.
21st. Okay.
Yeah.
Right
December
before
21st is the
Christmas.
deadline.
Okay.
Right before Christmas. So that's all. That's why I wanted to take a little more time to schedule these so I could, preview that for the next time. Trying to plan out some meetings. Go for it. What?
And Barbara and Mark, you guys want to pick a day for the evaluation meeting?
Yeah, we can do it over email if that's
Oh,
okay
okay.
with you. Is that fine?
Yeah.
Yeah.
That's fine. Yeah.
All right. Cool. All right. We got our next meeting. And I think we're done. Any last thoughts? All right. Thanks, everybody. See you August 11th.
Thank you.
3:58
you.
and it's adjourned.
Thank you.
Thank you.
All right.
Bye.
Bye.